Welcome back to Learn SKN, and today we're going to wrap up the Mayjune 2013 MOB Unit 1 Paper 2. We're going to wrap it up with question 6. So we have completed question 1, 2, 3, 4, 5. We are going to complete question 6 now from Module 3. So let's just jump right into it. The following are financial statements of General Hardware Limited for the year ended 30th June 2012. You have an income statement, you have a balance statement. You have your sales, your opening stocks, your purchases, closing stock, gross profit, expenses, net profit. You have your fixed assets, your stock, your debtors, your bank. You have your opening capital, your net profit. You have your drawings, you have your loans, your creditors, and your accrued expenses. And so we have to calculate the ratios. So compute to one decimal place the following ratios for the year ended 30th June 2012. And so the first one we're looking at is the net profit margin. And so to find the net profit margin, what you're going to do, we are going to use the net profit over revenue times 100. Net profit over revenue times 100. And based on the financial statements, the net profit would be right here, net profit 8,000, and then the revenue would be sales, of course, and that's 48,000. So that's how we get that one. So you take the 8,000 over the 48,000 and you times it by 100, and that equal to 16.67%, or you round it off to 17%. And so that's how we get that net profit margin ratio, 17%. Then we go on to the acid test ratio now, and that is current assets minus inventory over current liability. So current assets minus inventory over current liability. That is the formula for the acid test ratio. Remember, inventory is also a current asset, but for the acid test ratio, we're going to eliminate that one. So it's the debtors plus the bank minus stock over creditors plus accrued expenses. So we look at that now. So the debtors, so we have debtors right there, that's 12,000. And also what else is debtors, bank, and stock. Okay, good. So hopefully you could see better with this from this angle. Right? So we have the debtors plus bank plus stock. So debtors right there, which is 12,000, plus bank, which is 6,600, minus the stock, which is 8,400. And so you have it right there. And so you get 10,200. Now to get the current liabilities, now that's the creditors plus the accrued expenses. And so you have the accrued expenses right here. Creditors 3,200, accrued expenses 3,000. So you get 6,200. And so you put that under. So you put 10,200 over the 6,200, and you get your 1.6. Well, 1.7 because it's a one decimal place, so 1.7. So you get the 1.7 for the acid test. Then they ask us for the current ratio, and that's current assets over current liabilities. And so for this one, you go back right here, where you have your stock, which is 8,400, plus the debtors, which is 12,000, plus the bank, which is 6,600, and you end up with 27,000 right there, over the same current liabilities from above, which is 6,200. And the answer is 4.3 or 4.4 because it's rounded off. So 4.4. You have 4.4% right there. And that's the current asset, the current ratio. Then they said the stock turnover ratio now. What is the stock turnover ratio? To get that, you have the cost of goods sold over average inventory. And so how do you find cost of goods sold? What you have to do is the beginning inventory, right? The beginning inventory plus purchases. And so you have it right here. You have your beginning inventory, which is opening stock, 10,800, plus your purchases, which is 36,000. So you have that, you add them together, you get the 46,800 as you have here. Now you minus the ending inventory from that one. And so the closing inventory is right here, 8,400 minus that one, and we get 38,400. you divide that by the beginning inventory plus the ending, which is the 10,800 plus the 8,400, and then you divide that by 2. So you divide that by 2. So all of this, and then you divide it by 2, and your answer, sorry, all of this, then divide it by 2. So your answer is 38,400 over 22,200, and the answer is 1.73, or 1.7 if you want to have 1.7. That's your stock turnover ratio, 1.7%. Most ratios are expressed in a percent or a decimal or whichever one you choose. So that's the stock turnover ratio. The last one, long-term debt equity. Long-term debt equity. So how do we find that one? And so for that one, we have the long-term debt equity is non-current liability over equity. And so you have a loans as a non-current liability. So you have your loans, which is right here, which is what, 14,000, and then you have a capital plus net profit. So your capital is right here, 32,000, and your net profit is 8,000. When you combine them, you get 40,000. So it is the loan, which is 14,000 over the 40,000, and you get the 0.35%. Right? So that's part 1 of this question right here. Part 1. Now part 2, asking us now to explain what each ratio demonstrates about the performance of General Hardware Limited. So let's go through them one more time again then to look at the performance. The net profit margin. What was the net profit margin? The net profit margin was 17%. Now this one would be good, because that means that the company is making a profit. So that's 17% on revenue. So the company making a profit, right? Now you cannot really say, well, you can say good because of the industry that they're in, high volume, and so you know they wouldn't charge too expensive things. So 70% in a hardware industry might be good, but there's room for improvement. And so you can say it's good, but because they're not making a loss, they're making a profit, but they can still improve on the 17%. Then the acid test ratio gave us a ratio of 1.7%. Now this one is also, you know, it's fairly okay. The company is doing fairly okay. Where we say that, let's look at what the textbook says about the acid test ratio. Right, that's what the textbook says about that. Now the textbook has a whole lot of ratios right there, and so you can use it to answer most of the question because it contains the formulas also. So for the acid test ratio, let's say here, a firm with an acid test ratio of less than 1 to 1 cannot cover its current liabilities. And so we know that we are above this, so we can cover our current liabilities. So the company is in good standing as it relates to covering its liabilities. So that's a good thing. Then they ask for the current ratio, and so we got a current ratio of 4.35. It's kind of high, 4.35. And so if we look at what they're saying over here, it is normally said that a ratio of 1.5 to 1 is generally acceptable and good for the business. On the other hand, this is true. Example above, where the current ratio is 3.4 to 1, which is far outside the norm. So that's a bad thing right there. What does that mean? This often suggests that the business has too much of its money tied up in assets. Example, stock. So they're saying because it's above 1.5 to 1, it's 4 point, what we point out just now. So that's a bad thing. It's not in good standing as it relates to that. That means the company has far too much of its monies and whatnot tied up in assets, for example, stock. And this all makes sense when you look at the stock turnover ratio, because the stock turnover ratio is 1.7. That is relatively slow. You don't want it, so that means your inventory is piling up, thus our pay is so high. That means nothing is being sold, right? Sales are kind of slow, so that's not the best. You need a higher stock turnover ratio than 1.73, right? So that's the next thing you can deduce from that, because if you look at this, if you look at what the textbook says about stock turnover ratios, you'll see that they say that when it is high, that is good. A high stock turnover ratio is good. See right here, 5.95 or 6 times, that is good. Because they say here that in general, firms would want to keep the payment. Sorry, they say here this measure the number of times that the stock turned over in the financial year. That is the amount of times which stocks were sold and replenished. So if you telling me in the financial year stocks were sold and replenished only 1 point something times, that is not good. That is not good. Sales are slow, and that is not a good thing. And then they ask for the last one, which is the debt, which is the long-term debt to equity. Now I must say that this is good for the business, because the business has one that is 0.35. That is good. 0.4, that is good. That means that the company doesn't have a lot of debt, so they're in good standing. That's the last of this question right here. The firm is in good standing, doesn't have high debt, that's good. And so that's the end of this question here, the question 6, and that's the end of the paper, the CAPE 2013 MOB Unit 1 Paper 2. So that's the end of that one. Alright, so you know what to do now. You have to like the video, subscribe to the channel, hit the bell to know when I drop a next video, and that is it for now. So thanks for watching, thanks for listening.